AI hyperscalers quadruple their spending in just 2 years, and now they're burning close to $400 billion a year building data centers. That single line of spending drove 92% of US GDP growth last year, and without it, the entire economy grew just 0.1%. And right now, natural gas generates 43% of all electricity in the United States, and the on-again, off-again relationship with the Strait of Hormuz has already sent gas prices vertical, which we all see every day, and wholesale electricity prices are going to follow right behind it. Layer on the fact that summer heat is going to be causing electricity usage to spike, and wholesale electricity prices are going to be higher than we've ever seen them. And clears throat. When this happens, the biggest beneficiary is nuclear. Their fuel costs didn't move, but their revenue and their margins are about to, because all ships rise with the tide. And that's why I'm covering the top nuclear stocks that are built for long-term growth, especially after we've had a few pullbacks. But before we jump in, if you're getting any value for my videos, then please consider pressing the like button. And if you'd like to see more of my analysis and my deep dives, my stock trades in real time, then you'll want to check out my Patreon. Last November, I walked through the 4-tier nuclear stack. You've got mining, you've got fuel and enrichment, innovation reactors, and operating utilities. And today, we're going to be walking through that same framework, but we're going to be focusing on 6 big updates since then. And there's also a big lawsuit that you're going to want to know about. Now, what's changed is that hyperscalers stopped waiting, and they started signing. Microsoft signed a deal. Amazon signed a deal. Meta signed a deal. When you add up all the power purchase agreements, or PPAs, which are basically long-term electricity supply contracts, plus the equity stakes and co-development deals, there's over $200 billion in the form of nuclear contracts that are on the table right now. Here's the mechanism that makes all of this work. Wholesale electricity prices on the grid get set by the marginal power plant, which is almost always natural gas, because gas is the swing producer in most regions. When gas prices spike, wholesale prices spike with them, and nuclear's fuel costs are locked in for 20 years or more on fixed contracts. So when gas begins to run up, nuclear revenue and margins go up automatically, but their costs don't, and that's the whole machine. Now, if picking individual stocks is not your style, then it's no big deal. I'll be finishing off the video with ETFs that play in the same setup. Let's go ahead with the foundation, mining, and feedstock. So uranium ore gets pulled from the ground and converted into yellow cake, and that feedstock flows into everything above it. And that leads to the first name on this layer, which is Cameco, the world's second largest uranium miner that accounts for roughly 14 to 20% of the global uranium production. Cameco also owns 49% of Westinghouse Electric Company. When the U.S. government announced an $80 billion nuclear partnership with Westinghouse in October of last year to deploy 10 AP1000 reactors and multiple AP300 small modular reactors, Cameco started capturing economics from both sides of the supply chain. The uranium comes out of the ground on Cameco's side, and the reactor that burns it is partly Cameco's through the Westinghouse stake. In 2025, Cameco's share of Westinghouse profits grew 26% in a single year. Now, I do want to point out that there are 4 other miners in this layer that are worth knowing. So we've got utilities, data centers, and nuclear plants that are feeding them. They all run on hardened infrastructure because just one breach is going to take down millions. But nobody's protecting your personal infrastructure, your accounts, your passwords, or your trading logins. And that brings me to something personal and today's sponsor. When I first started this channel, I got phished by someone pretending to be a sponsor, and just one click on a fake contract was all it took for them to take over my phone, my computer, and this entire YouTube channel. Here's the thing, one tool would have caught that. NordVPN's Threat Protection Pro is the only VPN app with official anti-phishing certification, and it blocks 85% of phishing sites before you click, and it scans every file that you download for malware. Last year alone, it blocked hundreds of millions of scams, with 74 million in a single month. And if your credentials ever do get out there, NordVPN's dark web monitor scans the underground for your logins and alerts you the moment your brokerage password, email, or trading account shows up for sale. Because at the end of the day, nobody else is watching out for you. And right now, NordVPN is running an exclusive deal for 4 months extra on a 2-year plan, and their 30-day money-back guarantee makes it completely risk-free. The link is nordvpn.com/BWB, located down in the description. Energy Fuels operates the only conventional uranium mill in the United States that's located in Utah, with the bonus of being permitted to process rare earth elements that are alongside uranium. Then we have Uranium Energy Corp., which is the largest U.S.-based uranium producer, with shovel-ready in-situ recovery projects in Texas and Wyoming. And then we have Paladin Energy, which runs the Langer Heinrich mine in Namibia, which just recently resumed production after years of being offline. And next is Denison, which is a Canadian development stage player with one of the higher-grade uranium deposits. Now, an item to point out is that none of these have the integrated Westinghouse story that Cameco has. But if you want a pure play exposure to rising uranium prices, these are the names that you're going to want to know. Now we move up to Tier 2, the fuel cycle, where the supply squeeze hits the hardest. The primary name on this layer is Centrus Energy, the only United States-based uranium enrichment provider. So, after Russia got banned from supplying enriched uranium to the U.S., the domestic market opened wide up, and they're the only player that's positioned to fill it. Their backlog has essentially gone from essentially nothing to over $2 billion in federal and utility contracts inside of just 2 years. And there were other supply cuts that were announced earlier this year, and the demand is running way ahead of the supply for the first time in over a decade. Spot uranium is sitting at around $90 per pound, and that happens to be well above the price that incentivizes new production. Next on this layer is Babcock & Wilcox Technologies, and they're the only large-format commercial nuclear equipment manufacturer within North America, and their commercial backlog surged 85% year over year by the end of 2025. And Kairos Power signed a commercial manufacturing partnership with BWXT in September of 2025, and Google signed Kairos for 500 MW of power by 2035. That means that BWXT is a fuel supplier in the Kairos chain, capturing revenue from every reactor that Kairos sells. BWXT also manufactures TRISO nuclear fuel, which is the fuel architecture used in every advanced and small modular reactor, or SMR, that's being developed right now. When the advanced reactor wave begins to hit, BWXT captures revenue on 2 different fronts. Now we're going to go ahead and move up to Tier 3, the innovation reactors. These happen to be the moonshots. First on the list is Oklo, the Sam Altman-backed advanced microreactor company. The DOE reactor pilot program is targeting criticality milestones on 3 test reactors by July 4, 2026. And if Oklo's Aurora facility achieves self-sustained fission before summer, that's the first real proof that factory-built microreactors work at scale. I had brought up Oklo last year, and they've already moved up several 100% since then. Next up is NuScale, which is working through an active securities fraud class action suit. The lead plaintiff deadline passed on April 20th of 2026. Despite all that, I think that NuScale is still worth putting on your watch list, because if their integrated 77M design hits NRC certification around the same time that the lawsuit settles, then the SMR, or small modular reactor, completely changes the playbook, and that could lift well above this lawsuit. And the newest name on this layer is X-Energy, which recently just IPO'd. X-Energy is the Amazon-backed high-temperature gas reactor company, and Amazon has committed to deploying 5 GW of X-Energy reactors through AWS by 2039. And of course, ARK Invest is also a lead backer. In this space, the execution catalyst to watch is whether their XE100 reactor hits design certification in the 2027 to 2028 window. Now we move on to the very top of the pyramid with Tier 4, where a completely different structure lives. These are the operating utilities who signed those big PPAs that I mentioned at the beginning. And this is where the electricity structure really begins to capture extra margin for them. And the first name on this layer is Constellation Energy, and they're the largest nuclear operator in the United States, with 22 reactors. And after the Calpine acquisition closed in January, they're sitting on roughly 33 GW of total generation capacity. CEG started trading as a standalone company at the Exelon spinoff in February 2022, and it's now over 5 times that. They also have the Microsoft 3 Mile Island restart, which is locked in for a 20-year contract, where the 3 Mile Island's grid connection happened to get pushed from 2027 to 2031. But Microsoft has no intention of walking away from a 20-year contract because of a 4-year delay. And CEG's other 20 reactors are just going to keep generating PPA revenue the whole time. Next, we have Vistra, where the transformation is probably the most visible, where Vistra's free cash flow went from burning $1.2 billion in 2021 to generating nearly $4 billion by 2023. That's a wild flip within 24 months. And it all happened because gas and power prices surged while their nuclear and coal fleet stayed online with fixed cost economics. Vistra signed a recent deal with Meta for up to 2.6 gigawatts, which phases in from 2026 through 2034. And when power prices begin to spike, that nuclear fleet becomes the margin machine that carries the entire company. Now, third on this list is Talen Energy, which comes out of Chapter 11 in mid-2023, trading at around $38 a share, and it's now over 10 times that amount. That's incredible for the stock to go up tenfold in less than 2 years for a company that nobody even wanted. The market completely wrote off Talen as a dying coal and nuclear merchant, and 2 years later, it's the cleanest, pure nuclear operator in the anchor list after their 2023 divestitures. And their anchor deal happens to be with Amazon for 1.9 gigawatts, which Amazon actually renegotiated up after a recent ruling in December 2025 that made the original co-location structure untenable. So there's some litigation going on with Talen that you need to watch out for, but if it goes in their favor, and it's supposed to be ruled in the third or fourth quarter of 2026, then it could see a lot of growth. Now, there happens to be one name on the equipment side that ties into all of this, and that's GE Vernova. And they're a spin-off of GE's power business, and they're the ones that are building the BWRX-300 small modular reactors in a global alliance with Hitachi. Now, when utilities begin to deploy SMRs in the next decade, they need an equipment manufacturer with the engineering depth and supply chain to actually build them. And GE Fee is one of the only Western players that can do that. Now let's get to the part of the video where I showcase how I would be investing $100 across these nuclear players. I'd begin by putting $50 into Tier 4, which is the operators. In my mind, Tier 4 is the anchor of the entire basket, and it gets the largest slice because the conviction to me is the highest. These are the operators who already signed those long-term agreements. And with electricity rates going up everywhere, that means their revenue and their margin is also going to go up. That whole merit order mechanism is what's letting them print money when gas begins to spike up. Next, I'd be putting $25 into Tier 2, which is the fuel cycle. For me, that's the leverage play when demand begins to outrun supply for the first time in a decade. I mean, the way I see it, if you can control the fuel, then you control the speed of the entire rollout. And next, I would be putting $15 into Tier 1, which is the miners. Now, to me, the mining is the complete foundation because the supply is where everything is going to flow from. And lastly, I would put $10 into the Tier 3, which I see as moonshots. This is where the potential millionaires could be made if any one of them hits hard. And if neither of them hits, then the Tier 1, 2, and 4, they really carry the whole investment. And there you have it. That's my full allocation based on all of the new information that's available. And based on where your risk tolerance is, clearly, you can shift across each of the different tiers based on what your needs are because everybody's math is going to be different based on their risk tolerance and their time horizon. Now, I do want to point out there's just one last thing. This happens to be a 5 to 10 year setup. It is definitely not a 3-month trade. The grid is not being built overnight. This is definitely the long game. But the way I see it, the supply constraints are going to hit first, demand hits second, and the companies that own the leverage in between all of those are the ones that are going to be printing the money. Oh, and of course, for those of you that prefer a simpler exposure, here's several ETFs on the screen, and they cover the same ground with broadening out the risk, and of course, they rebalance for you. And as always, thanks so much for watching.